Taimur Baig, who's the Chief Economist, Asia at Deutsche Bank, joins us from Singapore. Taimur, good to have you on the show. Much focus is on the U.S. unemployment situation and, how that would just kind of give an indication about growth in the economy. We're rejoicing across the region this morning, but how sustainable is this rally?
Independent of the rally, I think the economic narrative that we have for the U.S., which is that 2014 would be a year when growth would be somewhat even better than already a fairly strong 2013, I think that narrative remains intact. We have seen some wobbles in the data with the payrolls disappointing last month and some of the jobless claims data also not particularly being impressive, but I think they can all be explained in terms of one-offs and bad weather. We think that between the housing recovery, the bottoming out of investment, and significant supply contribution coming from the shale gas complex, the U.S. is poised for a multi-year strong growth trajectory. So from that point of view, I think that the swoon that we have seen in global markets in the last 6 weeks or so were premature. I think the markets were probably getting a bit ahead of themselves. This pullback or even the consolation rally that you're talking about today, I think should be seen in the broader context that the underlying fundamental of the U.S. will probably be a very good positive pull for the rest of the world this year and next.
Taimur, whereas the outlook for U.S. economy is rather rosy and constructive, the problem is China. That is the big elephant in the room.
Sure.
There is a proper China scare in the world. The fact that China is slowing down is old news. How come everyone is worried about it now?
Right. I think, the slowing story is something that even the authorities own up to. If you see the 5-year plan that they have in place, they're looking at 7.5% growth on average. I suppose what is worrying the market is the risk of a disorderly adjustment toward that lower trajectory growth. And it can come from a negative spillover from the financial sector to the real economy. And hence, when you see that ICBC trust issue that became quite a bit of a fodder for discussion in the last few weeks, that fed fuel to the fire, if you will, that those who are China skeptics found it as a validation that, all that is wrong with China is manifested in this deposit going bad. The fact of the matter is, there are credit events like this and deposit events like this in a country the size of China on a regular basis. This was a particularly high-profile one. We don't think this is the end of it. But I think we should also take away from what has happened in China in the last couple of weeks that the authorities are capable of backstopping this sort of deposit going wrong. They have deep enough pockets, and they have their eye on the ball. So from that perspective, we think that, again, the market's concern on China also are a bit overplayed, if you will. And once we start seeing some export data for the month of January and February, we will see that China is also on the verge of having a big export-led recovery in 2014.
What's the sense on, this EM risk aversion trade that's playing out with money moving out of emerging markets and, U.S. becoming trade? Because at some point in time, there would be skeptics who would perhaps win the argument that everybody seems to be bullish on the U.S. and maybe it does not merit such optimism, even though the data suggests that things are looking up. From that perspective, do you think at some point in time over the next couple of months there would be a sense of semblance that EMs are not looking all that bad and tapering would not have the kind of impact that one had initially anticipated and thereby money would move back into emerging markets?
This is a fair question. I was marketing in New York just a week and a half ago, and I met a lot of fixed income investors who said that while retail money in EM has sort of become negative in the last couple of months or so, I think everybody's reading the same sort of analyst reports, but institutional allocation for emerging market investment is still substantial, and institutional money is much bigger than retail money, except that, the data that institutional investors are tracking institutional investors are not that widely available. So the bottom line is that there is still substantial flows available to be deployed in emerging markets. Emerging market economies have to differentiate themselves. They're not just a big asset class. Some economies are better, and India is a classic example. 6 months ago, India was the number one in the list of vulnerable economies, and it's no longer even in the top 3 because of the various adjustments and policy measures that India has taken. And every real money investor that I talked to were very interested in allocating funds toward Indian fixed income as long as the fiscal data were to remain as is, if not a little better.
Taimur, you went to New York 2 weeks ago. Ouch, that must be nasty. New York 2 weeks ago was cold.
The weather was not pleasant.
Yeah.
Pun intended.
No. So are you sure that winter is having an impact on US economy? Because that seems to be the consensus.
Yes, I think that the Northeast in particular, I mean, which is a big population concentration of the U.S., activities were certainly disrupted, and some of the data do reflect that. Once we go under somewhat warmer circumstances, as data for February trickles in, I think 2 months from now we'll be having a discussion of a very different type, which is that the underlying recovery was interrupted temporarily by the bad weather, but it actually remains intact.